All right, that's going to give us our total assets, and then we've got the liabilities and equity. Let's go into the liabilities first. And we've got the current liabilities. That's a normal financial statement subcategory representing those liabilities that are due within a year. An important subcategory, although the time frame is arbitrary, because we want to see the stuff that's going to be due soon, because I want to note that I have enough assets to pay it. Why is that important? Because it's possible for me to have a lot of net assets and still be illiquid, meaning I can't pay my bills. It's like, how can you not pay your bills? You have like millions of dollars in net assets. Well, that's possible, but the classic example is like a farm, for example, where you might have millions of dollars in net assets, but most of it is in property, plant, and equipment. I don't have any cash, right? So I can't pay my current bills that are becoming due if I don't have enough cash flow to pay the current bills, and I don't want to sell the farm or mortgage the farm, sell the equipment or mortgage the equipment in order to pay the current liabilities. That's the issue, that's the problem. So we want to basically kind of think about our current liabilities, which are going to be the accounts payable. Typically, that's going to be the amount that we owe the vendors when we enter bills, which is something we might not do as much if we're a small business, but as businesses get larger, it's going to become more important to track the accounts payable rather than just pay them with, say, bank feeds or credit cards when they become due, because the dollar amounts might be larger and the number of transactions could be larger, making the time value of money more significant and therefore worthwhile to see if we can pay our bills like 15 days later or something like that, right? If I pay a $100 bill 15 days later, not that important if that's the only bill I have. But if it's one of a thousands of bills that I have that I could pay 15 days later, that starts to become significant for cash flow purposes and time value of money purposes. So then we have the credit card. Now the credit card needs its own separate account as well, as does the accounts payable. The accounts payable, by the way, needs its own separate account because we're tracking the accounts payable by vendor in a similar way as we track the accounts receivable by customer. And we have the similar functionality that looks funny from a financial statement reporting because we would have a sub account with only one account in it. That's redundant. We don't really need that, but you can see why it happens functionality wise from the QuickBooks standpoint, because it has a sub account for each new category. And then we've got the credit card. So the credit card has its own subcategory because, like the checking accounts, it can be connected to the bank feeds, and therefore it has the necessity of the bank feed functionality, and therefore has a subcategory for it. Noting that oftentimes people don't think of credit cards as similar to the checking account. It can be a little bit more confusing to think of the credit card payments coming through the bank feeds, but it's actually easier because the credit cards, whenever you make a payment with a credit card, it will almost certainly be an electronic type of payment. And therefore, unlike the checking account where you might pay something with cash, for example, or you might have checks that are going to be involved when you make payments. Those won't be the case with a credit card. Everything will be electronic, and therefore normally, especially for small businesses, you might just simply record credit card transactions as they happen, as they clear the bank, depending on the bank feeds in order to actually construct that part of your financial statements, which is generally an easier thing to do. And it's just like when you pay for something with cash, except that instead of the checking account going down, the liability account is going up. You don't have any deposits in the credit card. All you have are the payments, the paying off of the credit card balance. All right, and then we've got all other categories are going to go into the other current liabilities, which in this case includes the sales tax, which QuickBooks, sales tax is a type of consumption tax. So if you're outside of the United States, you might have a consumption tax, similar kind of thing. We charge people and we have to pay them. Taxes are going to be the thing that differs from place to place. And that's mainly here. And then we got the loan payable, noting that loan payable is going to be one of the confusing components because you might have a loan that has a short-term and long-term component to it. So if I took out a loan similar to like a mortgage, most people are familiar with installment loans like a mortgage type of setup, although a business loan doesn't necessarily have to follow that same structure. But let's say it does. you pay off the loan monthly, you pay off a portion of the interest, which is the rent on the loan, and the principal. That means that the amount of the principal that is due within a year technically would be a current liability, and the amount that's going to be extending beyond the year is long term. And you can imagine why that's important, why that makes sense, because if you're on that farm, for example, the mortgage on the farm is going to be the current portion of that. You're going to have to pay that soon. You got to make sure you have the current liabilities to pay that. And then the stuff that's not going to be due within a year, then you might not have the money now to do it, but hopefully you're going to generate money and you'll be able to pay those a year later. If you can't, how can you fix that? Well, one way you could do it temporarily is to shift some of the short-term debt to long-term debt, extending the terms of the loan, right? That can make you more liquid possibly in certain scenarios, although it will run into a wall, that strategy at some point. So then we have the long-term liabilities, which typically don't have much in them, except in this case, of course, the loan payable, the long-term portion of the loan payable. Now note, breaking out between short-term and long-term portion of the loan is kind of a pain, and we'll talk more about how to do that later, but typically you're going to want to do that with adjusting entries possibly, because from a loan standpoint, you possibly want to track your loans, tying them out to the loan balance of possibly an amortization schedule, which means that you want a different account per loan that will easily track that. And breaking out the short-term and long-term portion will be tedious if you do it after every payment. Therefore, it makes more sense to do that periodically at the end of the month, end of the quarter, end of the year when you do your financial reporting